Okay. Good morning, everyone. How you doing?
Good morning.
Morning. Um, Thanks for joining for another agent training. We have a lovely Matt Davis with us. I always point like you're going to be in the same spot on everyone else's screen, but you're probably not. Anyway, he's right there for me. So, Matt, welcome. Thanks for coming.
Yeah, thank you.
Yeah, do you want to start by giving us just like a brief intro on who you are, how long you've been in lending, what you love about lending, all that good stuff?
Oh, what I love about lending. Wow.
Throwing curveballs at you, Matt. I told you I would.
Not as much these days. No, I just joking. But Matt Davis here with Caliber Home Loans. I've actually been in the industry now, doing mortgages for about 19 years. So I've seen a lot of ups and downs over these years as far as the markets. A lot of changes, a lot of government regulation changes, especially this year with COVID overlays. That's been a lot of fun. So yeah, it's we're definitely in interesting times, but I absolutely love what I do most of the time, but it goes through some spurts where, like COVID overlays this year makes it a little more challenging. But absolutely love just the problem solving, helping clients and navigating through the process.
That's so good. And where do you live? Who's your family? Give us the personal spiel.
Yeah, so I live here in Fortville. I have a wife that we've been married 17 years and a 13-year-old son and 11-year-old daughter. So keeps us busy.
Perfect. That's so good. Guys, so Matt and I are going to do a little Q&A session today. So I have tons of questions to kind of run him through and get you guys up to speed on Lending 101 and things that you should know. If you have questions, feel free to unmute yourself and pop in or drop them in the chat and I'll make sure they get asked. So, Matt, can you first walk us through when agents are first interacting with a client, what should they be letting them know about lending? What should that process look like?
One question, of course, is asking if they've been pre-approved. Really important question. And if they haven't, the reason that they haven't. So what we've been seeing a lot of lately is people are just kind of on a whim, just saying, hey, you know what? I think I'm going to buy a house, or they're driving around and they see a house that they love and they go ahead and they want to write an offer and they haven't been pre-approved. And we're scrambling to get that done in one day. So anytime that you can have them go through that process ahead of time is extremely helpful. Some of the other questions just to kind of feel out with your clients is, I know that a lot of realtors don't like to pry into the financial part of their lives, which is understandable, but it's always good to just kind of in conversation, just, asking what they may do, just getting to know them a little bit better, and then finding out, do they just start a business? If they just did, then that means you definitely want to try to get them in front of somebody to find out, can they really qualify? So just asking a few questions, or, understanding, do they have down payment money, or just a little more details to feel out.
Matt, should clients get pre-approved before they even go and look at houses?
I believe so, yes. I understand that it's, some agents believe, or they don't want to turn off the client. So they want to at least get to know them and maybe show them a couple of houses and drive around a little bit. I don't see anything wrong with that, but you also don't want to invest too much time with a client that can't qualify either. So, and it's a really good idea, especially in this market, multiple offers. Pre-approvals are incredibly important, as I'm sure probably everyone knows. So not to have that in time to go ahead and write that offer could be the difference of getting the house or not.
And how much time do you like to have to get a pre-approval done? Like, obviously people are throwing shit at you and you have to get them done really quickly, but like Matt's ideal time frame to get a pre-approval done.
A few days would be nice. Just because the ebb and flow of everything else every day is different, that there could have been a number of other clients coming at the same time, and also if someone has a little complexity, being able to have time. I mean, honestly, even a full week, especially if somebody is self-employed. So that way we have time to go ahead and analyze tax returns. It may take them a few days to get those done. So I have seen more in the last couple of months of self-employed borrowers calling, asking to have a pre-approval done in the next 2 hours because they're trying to get an offer out. And yeah, it's been a roller coaster. It's been fun.
Steph asked a great question in the chat. How long does an approval last? Once you've issued that, does that have a timestamp on it?
So yeah, so the credit report is 120 days.
Okay.
So that gives us 120 days. Now, it doesn't mean that everything expires at that point. So what I will do is go through and analyze everything, make sure everything's fine. Of course, reach out to the realtor then and let them know, here's our parameters. And then we know what the whole picture looks like. And then also let them know is, okay, here are some of the potential issues that we could run into. Here are some kind of the elephant in the room. And then also regarding that 120-day time frame, yes, everything looks great. If the credit report expires, we just need to update that down the road. You know, they have excellent credit. I'm not worried about them. So if it's 6 months later, everything's going to be fine. Or it may be a client that's like, they are just skating through right now. If anything changes on their credit, they may not be able to buy after 120 days. So it may be a good idea that, okay, let's find a house in the next 30 to 60 days to get in the house. And that's a conversation that we'd have up front so we know what we're working with. So the last thing, you know, an agent wants to do is, you know, it takes a few months and all of a sudden they find the one, we have to update credit and now they can't qualify.
And Matt, what do clients need to turn into you to get pre-approved? Like, what documents do you need from them?
You know, it really depends. So knock on wood, in all these years, almost 19 years, I've not had a client where I said they were qualified and had to go back on that, except 2 times. One gave me a fake social, so couldn't control that. It was a purchased social security number. And then the other one, they went out and bought a car even after asking me in the middle of the process. And I said, it's going to kill everything, and it did. So other than that, though, is what I do is make sure to do a good screening job. But after I see the credit and ask a number of questions, I'm going to know whether I need to see their pay stubs or if I need to see tax returns and so on. So it's case by case. But if you're having that conversation with the client, you know, it may not be a bad idea just to give them a heads up that, you know, your loan officer may need to, you know, if you're self-employed, have your tax returns ready for the last 2 years. Especially your personal, and if you have business returns, K1s. K1 shows the ownership of the company and the percentages, but to have all that ready, you know, maybe reach out to your accountant if you don't have those, or have them in a format that's easily attainable, because that's one of the things that really slows things down. Pay stubs would be another one, especially if there's bonus income, commission income. So just have them kind of get prepared to be able to get those. And if they have commission or bonus, make sure they can get them over the last 2 years, the year-end pay statement that'll show the breakdown. So those would be good things.
It could be as little as just running their credit, and then it could be as much as like tax returns and pay stubs and all that stuff.
It could be, right. And if it's really questionable, it may even be something that we'll submit to an underwriter as a to be determined property to really get their eyes on it and make sure. So it can really vary, but I think those are some of the things that would be good just to mention to the clients to kind of be prepared for that may be needed.
That's great. And then, so realtors are out with clients, they find the perfect house, they put it in offer, that offer gets accepted. What does that look like from the lending perspective from that point on?
Yeah, so one thing that's really, really important, especially in the whole industry is dealing with record volumes right now in a very short period of time. It's kind of a tsunami of, you know, the analogy that I give is it's kind of like you're working at the McDonald's at the truck stop and everyone's getting their food, you're getting it out in a minute or 2 minutes or whatever it is, and all of a sudden 3 busloads of people just show up. And now it's just there's only so many people behind the counter. only so many people that are helping with appraising, with the underwriting, with processing loans and so on, and trying to get them through. But we have so many contracts flipping back to real estate that we need to close in 30 days. We need to close in 20 something days or whatever it is. And it's just really, really important then to have everything in place really well and efficient on the front end, which that means, so at that time that they're under contract, make sure that the loan officer is aware of it immediately, or maybe even before they're going to sign, that they have a heads up that it's going to be an accepted offer. That's really helpful. It could even be on a weekend that, many times I'll go ahead and get them started over the weekends to get a head start going into the week. The other one that's really important is to make sure it's a fully executed contract. So that means, what I mean by that is signatures by the buyer and seller on all the, on page 8, the counter offers, and then also making sure the one that gets missed so many times is a little box checked on page 8 as far as accepted or countered, or actually it's usually accepted, it's there, but to be checked countered. So those are really important to have for the appraiser when they complete that. So completed paperwork on the front end, and then also knowing who the title company is extremely helpful as well.
That's great. I think for most of us, well, me in particular, the lending, what happens on your guys' side of things is kind of a mystery to me. Like, I know that, we just send this purchase agreement and then there's magically a lot of money that is used to buy this house. Can you talk through, pull back the curtain for us and tell us, okay, you get that purchase agreement, what happens after that?
So you want us to tell the secret sauce? No, I'm just kidding.
Yes, that would be ideal.
So let's see here how the process. So basically, purchase agreement comes over. Immediately, we're looking through the purchase agreement to see, actually, this is something really important as well, and you may ask this question later, but first thing that I'm doing is I'm reading through the purchase agreement to see, when is it closing? What are the stipulations? And also seeing, who the title company is. But then looking at further conditions, it's amazing how many times things are kind of hidden through the contract that we want to read through and see, is there anything in there that may cause complications, which that could be, anything that's mentioning repairs to be done. So if there's anything in there, we're going to go ahead and then make sure to reach out to Realtor right away to say, hey, this is fine to be in the contract or it's not. So what I mean by that is anything that's on a purchase agreement, it has to be followed through completely. So underwriters are going to make them, or they're going to make everybody to follow through on that. Meaning if it says, a new shower to be installed in the purchase agreement, then if it's not done when the appraiser goes out there, then we're going to require, the underwriter can require the appraiser to go back out, re-inspect to make sure it's done. So to elaborate on that a little bit more is that if everyone, maybe all parties, buyer and seller and agents decide, oh my gosh, the shower is on back order, we're not going to have that in time. Well, now that creates a problem because it won't be installed in time. Even though everyone's okay with it, it's not okay for the lender because it was in the contract. So it's a good idea that if there's anything that you may not want the lender to make sure it has to be completed, to have that in a separate, maybe addendum. So that's one thing, but that's an item that we're going through and looking at. And then at that point, reaching out to the client, basically going over the phone, all the terms and conditions and making sure everything sounds good, getting the disclosure set up, sent that out to the clients, along with a list of items, requesting for them to get those in within 2 business days to complete signed documents. So that way, once that happens, we can send it up to underwriting, which means at that point, it goes to underwriting and within, well, in this environment, it's a little different. In a normal environment, within about 48 hours, that's already been conditionally approved by the underwriter. And they have now said everything looks good on the file, but we now need certain items. So that could be the appraisal, could be title work, could be bank statements we still need. And then that's where the processor starts reaching out to the client, requesting those items, and we're working on all these different background checks behind the scenes. It's pretty incredible how much actually goes into a real estate transaction, between the realtors on both sides, to the title company, to the appraisal being done, to we have search engines looking to see if they own any other real estate, if they're untitled any other real estate that they may have even forgotten about. And it could even pull up an old property from years ago. So we're just going through all the checks and balances along the way, all the way through until around closing time.
That's so good. And then can you talk a little bit, like you've mentioned appraisals a couple of times. Can you talk about how that's connected to you? What happens there?
For appraisal, kind of what it is or what is, or okay. So yeah, I guess going down to an elementary level, basically an appraisal is not telling everyone exactly what the value of the house is. It's basically trying to make sure that the value of that collateral that the money is being lent on is at least as much as what the sales price is. And it's a really, really tough job for an appraiser. I would not want to be an appraiser, especially in a market like we've seen right now, is that values keep going up. It's kind of one of those things, is that it's the argument between the realtor and the appraiser. Is the appraiser, I feel like the realtor's like, well, the appraiser keeps not hitting a value, how are home prices ever going to go up? And then the appraiser is like, well, there's not data there to support that new higher price. So then how can I go ahead and make it work there? So it's a really difficult place for the appraiser, but what they're trying to do is find comparables that are close in proximity to the bedroom count, to the style of the house, to the age of the house, to make sure that it's approximately what that value is. It's not perfect. Thank goodness we actually have a list of appraisers that we have. So we don't use an appraisal management company. So I know a lot of lenders, especially the bigger banks, will use, they send it to an appraisal management company that then farms it out, and it's a revolving door of appraisers coming in and out. And they have no idea. They could be somebody at first day on the job. And that's where they run into a lot of appraisal issues on value. So thankfully, we have a list of about 10 of them that we do a round robin on. But yeah, they're just basically trying to at least make sure it's worth what the sales price is.
So do appraisers kind of work as like a checks and balances for lenders to make sure that amount that they're lending is right?
Yes, just to make sure that the bank, or for Fannie and Freddie as well, Fannie Mae and Freddie Mac, that's really, they're trying to stay within those guidelines for them, or it could be VA or FHA. But there are certain requirements, and then they have certain parameters they have to stay within as well. So that's why, and it's pretty tight parameters that they can't just, a home that has 2 bedrooms, even though it's right next door to the subject property that has 5 bedrooms, they can't just make adjustments for the square footage and so on. It doesn't work that way. So they do have to find something that's very similar in a number of different categories. The other thing that they're looking for is, there's conventional, there's FHA, there's VA. So there are different types of loans that are out there. Conventional is the most common, especially in this market, but depending on what that type of loan is, there may be requirements on repairs that may have to be done as well. So anytime if you're writing an offer that's going to be conventional financing, it's going to be a little more lenient regarding anything that may have to be fixed on the house. You could even have unfinished flooring. So the carpet doesn't necessarily have to be in. It does have to be habitable. So, you have to be at least being able to function and live in the house. Actually, the electricity could even be off. So that's allowed. Now, FHA is kind of that next step where it's going to be a little more stringent. So one of the biggest ones that appraisers will catch on that is flaking paint. So if you have a house that has flaking paint, especially in the exterior, they're going to have to scrape and paint it to satisfy the appraisal. And that's kind of the biggest one that we see that kind of gets caught, that maybe agents maybe forget or didn't know. So if you ever have a property that you're listing or trying to buy, make sure everyone's on the same page, that it's going to be okay, that they're willing to go ahead and do that. So if the whole house needs to be done, that may be a deal killer.
Okay, you've brought us to a great place. All of these different loan types that are confusing as hell. I've been in the industry for 2.5 years and I still get them confused. So we've got conventional, FHA, VA. Is there another one, Matt?
USDA, which
What?
USDA?
I was like, did you just say Rusty A? What is that? Okay.
Yeah. USDA.
Walk us through what all those are again.
And I don't think anyone in the office is probably doing much USDA because that's rural. So I think most agents are working downtown for the most part. But so conventional, let's see here. I mean, there's so many different facets of these, but on a high level. So conventional typically means better credit scores or more money to put down. And so that can allow somebody to, especially if they put 20% down, not to have mortgage insurance. Mortgage insurance is PMI, private mortgage insurance, where basically that's being paid not for the buyer of the house or the consumer, not to protect them, not like homeowners insurance, but it's in case they default on the loan, and a mortgage insurance company is collecting those premiums to help cover some of those losses for the bank. So that's what that is. But conventional could allow you to avoid that. It can also allow you to get a little bit better pricing on the interest rate possibly, but also the mortgage insurance can be cheaper. And it's just more lax on the guidelines. FHA is the next one, and conventional requires at least 3 to 5% down, depending whether they're a first-time home buyer or not. FHA is going to be lower credit scores typically. They've had some blemishes on credit. Maybe that they just don't have much money to put down as well. So FHA is always kind of had that, it's carried that reputation that it's a first-time home buyer program. It's not, but it's just because it's a lot of times first-time home buyers because they're in those situations. But they could be first time, third time, sixth time, it doesn't matter. But FHA is where, again, on the appraisals, it's a little more tight. On the credit, there's just more to analyze. So underwriters are going to look at their credit history a little tighter, but they will allow them to buy the house with much lower credit scores. So, but then on that situations where, they can put as little as 3.5% down, but they will have PMI for the life of the loan. As where conventional, you can get rid of it when you get to 80%. But, the reality is most people move out before PMI is going to drop off, especially someone only putting 3.5% down. So it's not that big of a deal, especially with how low interest rates are right now. But, it's just one of those things that, either wait a long time to build credit up and save up. And at that point, interest rates are probably higher and it doesn't make sense. So that's FHA.
Did you just say FHA, you will always have PMI for the life of the loan? Is that right?
Yeah. Yes. If you put, there's one little stipulation, I believe it's 20% down, maybe a 15-year or something like that. You may have it for 11 years. Okay. But it's basically anybody that's putting the 3.5% down, it is now for the entirety of the loan. That has changed over the years. It's flip-flop back and forth. That program is backed by the government, and it just depends on the default. It all depends on how much money has been paid in on all those premiums to, whether they have a deficiency or a surplus of funds, whether they're going to go ahead and lower those premiums or maybe allow them to get rid of it. So for quite a few years now, it's for the life of the loan.
That's great. And then VA, high level, what is that?
Yep, high level, that's for veterans. So not every veteran is going to qualify. So it depends on how much active duty service that they've had, or if they've been in the reserves for long enough. But it allows them, it's a great program. So if they qualify, it allows them to get 100% financing. So 0 down payment and no PMI. And if the veteran if they're deemed by the VA to be 60% disabled, I'm drawing a blank. 10% disabled, 10% disabled or more, they actually then, they don't have to pay a funding fee that goes along with that program as well. So it's just another little perk, but it's a great program. Now, regarding those appraisals, we have no control over those. There's a roster of VA appraisers that are out there, and they can be pretty strict. So just to know on the buying or selling side of the transaction, they do have a little more stringent list, and they are usually like 70 years old and grumpy. It's just, I don't know why. It's just how many of them are. That's probably the one downside, but otherwise it's a phenomenal program.
That's great. And then we won't use USDA probably very much, but can you give us a high level of what that is as well?
It allows the borrower to do zero down. And then it is restricted geographically. So you actually can go onto a website, USDA, property eligibility, just type that in a Google search, and then actually plug in the address, and it'll show you on the map whether it's eligible. So it's going to be pretty far outside of Marion County. But it just allows the client to get in if they don't have money saved up for the down payment.
Great. Steph has been asking some great questions in the chat, so I'm going to pop over to those. I think this was about the FHA paint thing. Yeah, is the only way to get around that is if it's sold as is.
Well, they just can't do FHA financing.
So you have to have like a really strict, you essentially, like if you're getting an FHA, you're going to have like a pretty strict appraisal, and we'll have to.
I'm going to back up on that. So it's more strict than conventional. So it's really, most of the items are going to follow suit with conventional. However, the electricity has to be on, like they have to have the utilities on to make sure it's habitable. Any appliances that are in the property that are fixed to the property, they have to make sure they're working. Yeah. And the flaking paint. So if there's any flaking paint, that has to be addressed. Those are the major ones. Outside of that, it's going to be pretty similar to conventional. So it's not, FHA used to be really, really strict. There was like a whole nother addendum that was, you know, they had to check off everything. So it doesn't mean if you get an FHA offer, it doesn't mean run. Like, you know, if you're, or on a house that you're going to offer on, like, oh my gosh, like if you have a client that's offering on a property and they have to go FHA, and the list agent, there's some of the list agents that have been around for a long time and they remember the old days that it was like a big problem. And if they fight back on it, it's really, it's not necessarily a big deal unless it's like flaking paint, major flaking paint on the house, or they can't turn on the utilities. Something along those lines. Does that make sense?
Yeah, that's super helpful. And that's good to know just from I'm very new to the industry. So obviously you see people like, oh, it's an FHA offer.
Yeah. Yeah. And if I led on to, if I was a little over the top on that earlier, then it's not as bad as what I was maybe alluding to earlier. But again, as those couple of items are ones that would cause it to steer another direction.
That's great.
Hopefully that's helpful.
Matt, can you talk about some more do's and don'ts for clients? So you've already told us no fake social security number and no buying a car when Matt says not to buy a car. But what other things should clients do or not do?
Yeah, opening other credit during the process. So definitely it's a good idea to mention to clients to just don't open any new credit. They can use the credit cards they have, or make sure that they consult with their loan officer before they do anything financially. Don't put in large deposits into their bank accounts without talking to the loan officer. So something that we're definitely, we have guidelines that we have to follow. It's not something that we made up. It's Fannie Mae, Freddie Mac, FHA, is that we have rules on where money comes from for down payment or for reserves. And it cannot just be cash that just showed up one day. So there's so many times that clients are, you know, they're getting ready to buy the house and all of a sudden they're like, oh, mom and dad are going to go ahead and give us some money, and they just have mom and dad give the money. And before we even have a chance to talk to them, and maybe the agent has already talked to them, and just that's a good time to maybe mention, just keep everything still right now with finances until you talk to them. Don't move money around. Don't put money in your accounts. So that would be another one.
Yeah, that's great. Okay, and then along that same line, what are some do's and don'ts for realtors when interacting with you? So you've said if there's, like renovations that have to happen to the house, maybe putting that in an addendum and not sending that to the lender. What other really good tips like that can you give realtors for like, these are things that you should know when working with a lender?
Yeah, so do's and don'ts. So do's, just be, on the contracts, just really be efficient on that, making sure that everything's put together cleanly. It really helps the whole process. So that way it's there for the lender, it's there for the title company. And then making sure, here's another one, is really if you're wanting to make any changes along the way, so maybe that through inspection responses, this is very common, I've seen a lot of this lately, is if anything's changing to where all of a sudden, well, in lieu of doing repairs, want to go ahead and get maybe money paid to the buyer towards their closing costs and prepaids. So that's allowable, they can get money. They can't just get a check, unless you're doing something outside the transaction, which I wouldn't recommend on that. But that's in your world. But on our side, it can be paid towards the buyer's closing costs prepaids, but just reach out to the lender and just say, hey, this is what we're thinking about doing. Would this work, or how should we do it so we make sure it works and doesn't cause problems? Because there are rules on, how much money can be paid to the buyer towards their closing cost prepaids depending on the transaction. So for example, on a conventional, it can only be, depending on their down payment, maybe only up to 3% of the sales price. Or what you don't want to do is all of a sudden say, well, there's $5,000 worth of repairs. We'll just have a check or money given to the buyer. There may only be $4,000 of closing costs and prepaids, and now they left money on the table. And that's a way to have a client to be upset with you as the agent, is because, well, you go to closing and all of a sudden they had to sacrifice $1,000 of the money. They can't get it all. The other is the verbiage, making sure that it is in a way that it's okay for the lender that money can be given, because there are rules. Money can't be given from the seller to the buyer for down payment. It can't be given to them as just hey, here's an extra check, or for repairs. So then just making sure that that's all correct. The other thing is if it is being changed, have that on a separate amendment to where it's strictly just money being paid, X amount of dollars towards buyer's closing costs and prepaids, not in lieu of repairs. Because if it says in lieu of the roof that's caving in, well, now we need to make sure that, okay, well, is the house going to be okay? And now we probably need the roof fixed. So that's important. The other is just to be above board on everything too, is if you are thinking about doing something different or changing or something with a contract, just to reach out and just kind of talk it through and make sure, instead of trying to hide things. I've seen some of that in the past. That doesn't happen at Platt. So that's good. I think everyone's being trained the right way on that. And then the other is, there's another one that came up. So going back to the limits as well, is that like on an investment property, this is one that just came up recently, but on investment properties, seller help is limited to only 2% of the sales price. So that means, if you're doing a, $75,000 property, that's only $1,500 seller help. So I know it's very common on a lot of contracts, there may be $2,000 or $3,000 or $4,000 at times. But if that's how you write the contract, or if that's how you try to change that along the way, that could be leaving money on the table that the seller gets and the buyer doesn't. So one of those quirky little things. Lastly is actually just kind of thinking this through, is money that can go to the buyer. So not every lender is this way. We allow it. I know there's quite a few out there that actually, they look at the seller side of the settlement statement and they won't allow it. So it's going to be a question for the lender. But we will allow money to be paid from the seller to a contractor from the seller side of the person or of the closing disclosure. So the reason I'm mentioning that is because this comes up a lot, and I work through this with a lot of agents that are Platt. That's a great solution. So many times that due to repairs needed, they don't want to have the work done ahead of time. They have a contractor picked out. How can we get this money, or how can we get these repairs insured for the buyer to have that done? Maybe it's too big for seller assistance for the closing cost prepaids. So maybe it's a $10,000 item. Well, we can't, there's not enough closing costs and prepaids for that. But if they have a contractor picked out, that money can go from that seller to the contractor on the settlement statement. We're not going to scrutinize it. We're just going to assume. I don't want to see it in the purchase agreement. So I don't want to say, well, the seller's going to give it for these items. We're just going to go on the assumption that the seller could not pay the contractor before closing, and they had to pay them at closing. We're able to read between the lines on that. So we're not going to investigate and scrutinize and so on, but there are some lenders out there that will not allow that. If they see anything that's being paid, they will say that's an issue and they won't close it. Any questions on that? Or
sorry, I'm reading something in the chat. Matt, can you talk about lending programs that agents should know about in the industry, or maybe things that you provide at Caliber? So, like your physician's loans and stuff like that. Can you talk about that?
Yeah, so we already touched on, quite a few of those that, the pretty standard programs where there's the conventional 3 or 5% down or more. Then there's FHA, 3.5% down. There's down payment assistance program through Indiana Housing, for example. So, if they can come up with the money for the down payment, it's going to be better overall long-term. But if they just can't come up with the money, it is a good option. But it just becomes, a little higher interest rate or higher fees and so on for that program. VA is another one we touched on. But then there's also some other programs such as like a rehab program. So right now, with how inundated the industry is, one, it may be difficult to even get under contract on that, on the renovation loan, just because it's a little longer closing time frame. Also just the volume that we're dealing with. We have to be a little more careful in what we take on there. So if it's a major project, maybe not the right item right now, but basically what it allows the buyer to do is to, especially when we head into the winter months, things slow down, it's a great option. Allows the buyer to roll in the cost of repairs into the price of the home. So their down payment now, maybe it's based on, so they still only have to come up with maybe 3.5 or 5% down. And it's going to be the 3.5 or 5% down of, let's say it's $100,000 property and they want to roll in, $30,000 of, repairs or updating the kitchen or different items. They only have to come up with that down payment percentage of that total amount. So a lot of buyers don't have an extra $20,000, $30,000, $50,000 laying around for all those improvements. So it's a great fix, especially on those properties that are a little stale. So if they've been sitting there for a little while, it's probably because something needs updated, something needs repaired. That's a great program for that. So especially if the client loves the floor plan, but they want to go in and remodel, then that's something to work through. Now, what's really important though, is it's not a HGTV kind of, hey, I was watching this and I want to go tackle all this myself. They do have to have a contractor. So the home buyer cannot go in and do all the work themselves, because that generally turns into a disaster most of the time. So really important to, if they are going to move forward on something like that, one is I'd be happy to talk to anybody about how the program works, some more of the details later, but then also to make sure that they're working on getting a contractor set up right away. The biggest hang up on the program though, it is something that you have to be more patient. It's more of a 45 to 60 plus day closing time frame, just because there's a lot of I's to be dotted and so on with the contract, with the contractor. You have to have all the bids in, everything lined up perfectly before the appraisal can even be done. And then once the house closes, then they can start the construction process. So again, it's a phenomenal program, but it just depends on the application and so on, the timing. The other nice thing about that is that can be done for investors. So it doesn't have to be somebody on a primary residence. Helped a number of agents with this, is where investors, we want to leave those kind of more of a, I guess the application for a lot of the realtors clients has been, maybe they just want to go in and they have paint, flooring, maybe a bunch of cosmetic, $15,000 or $20,000 worth of items. but they can go in as an investor and put 20% down and then roll in those repairs. So that might be a good question for like Rex, for example, is that he's been down that road many times. So it doesn't have to be just a primary residence.
Andreas asked a great question. When agents are going through this process with you, would you be the main point of contact for this loan, or will there be multiple different people on your team that an agent or clients would be interacting with?
Yeah, so it depends. So the normal, probably either I'm talking with the client up front the first time, or at least I connect with them generally, or I have somebody on my team that's, it's kind of like nurse and doctor in a way. As far as, they come in and they're going to go ahead and gather the vitals. So they may gather the information like where do you work, what's your social security number, things like that, just compile it. And then I'm analyzing and looking it through, to make sure everything looks good. Maybe something that they're able to go ahead and, go over with them, or myself if I feel that's needed. So it just depends. So that's on the front end. And then, so we do have a process. I have someone else on my team that helps them the next stage once they're under contract, getting all the information out to sign disclosures, what documents are needed the rest of the way. And then I have my own processor as well. So we have a really smooth process from start to finish. But it's a team of 4 of us that are assisting all the way through.
That's great. This is a random question that just popped into my head. What's the difference between a pre-qualification and a pre-approval? Or is it the same thing, just different names?
So yeah, that's a good one. So technically they are different. However, the whole industry pretty much uses pre-qualification. They call it a pre-approval. So if you go ahead and send over a pre-qualification letter to a seller, they're going to go ahead and probably throw it out, or it's going to go to the bottom of the list. So everyone calls it a pre-approval. A pre-qualification is just the loan officer gathering the information and then giving their opinion whether they think they're going to be fine. So it says those pre-approval letters are coming over. It's basically just as good as the loan officer's experience and whether they think they're qualified. It's really all it is. So it's really important to know their experience level, how long they've been doing it, and everything else. But that's all a pre-qualification is. A pre-approval is where it's actually gone to an underwriter and they've said they are actually pre-approved. Well, there's no way that we could send all of these through to underwriters to analyze all these clients before we issue a pre-approval letter for somebody to write an offer, if that makes sense. So, because especially when we have, someone says, hey, we're writing an offer here in the next 2 hours. I know we've never talked. Can I get a pre-approval really quick so I can send that offer in? There's no way that we can go ahead and send that to an underwriter, have them review everything and condition it and send it back out. So the whole industry calls those pre-approvals.
Okay, got it. That's helpful. Thanks. Matt, you were mentioning at the beginning of this call about COVID overlays. And I know we talked a little bit about that the last time you were on a training with us, but actually most of the people you see here are new since you have been with us. So can you tell us, what has COVID changed? Is there anything that agents should be extra aware of now going through the lending process?
Yeah, and it's something that just keeps evolving. Of course, everyone knows what COVID is, and I'm sure everyone knows what an overlay is. It's basically just something that's now above and beyond what the normal guidelines were. And so once COVID started back in basically March, I think when this started happening, is that Fannie Mae, Freddie Mac, the banks, lenders, and so on started worrying about, people started getting laid off, furloughed, businesses closing. And so the question is, if we go ahead and write this loan, are they going to default on this like a month or 2 after we go ahead and close on the loan? And it's a legitimate concern. And so as everything was unfolding at that time, things were looking pretty gloom and doom to some degree. And so basically they really tightened up things fast. Like even jumbo, I guess, is something we haven't talked about. That's a loan above $510,000, so it's much bigger loan amounts, but that's a whole privatized arena. Those even kind of went away almost with a lot of institutions for temporarily. So this has been something that as the data keeps coming in, the lenders have been adjusting to try to, based on a risk level. And so almost every single week since March, we have had changes to these programs. So if you can imagine is that, you know, programs and guidelines that we've always known, which they adjust from time to time, that they just keep moving, it makes it really difficult then for the lenders to go ahead and try to navigate with that and also be able to hit turn times as well. But some of those to be kind of conscious of, so they were really getting a lot tighter. We've been seeing some of them get more lax just recently, thank goodness. However, you know, based on a lot of the things in the news with, you know, the schools and the sports programs and everything else that we're seeing, are things going to get tight again? I don't know. But at least right now we're heading in a positive direction. But the items to really look for is someone that's self-employed. They're definitely going to go ahead and analyze their income more closely based on what their income has been this year, as opposed to where it's always just been kind of tax returns in the past. So they need to have maybe a little stronger credit, more money in the bank, you know, to make sure that they're going to be a sound business going forward. The other is somebody that's buying or has rental properties. You know, there could be vacancy rates, you know, if tenants aren't paying paying their rent, you know, that could put them in a position where things are a little tighter. So we want to make sure that they have a number of months reserves, or we might even have to require, depending on credit scores, copies of the leases, making sure that they've been receiving rent for the last couple of months. So, you know, with that said, anybody that's self-employed or, you know, other people would be is somebody that has bonus or commission income. We're just going to have to analyze a little bit tighter than what we used to. And that's at least for now. We don't know what that's going to look like going forward. But on those type of clients that if we're hitting, you know, one or many of those boxes, it's really important then to maybe check with the lender when you're writing that offer, what's a realistic closing time frame for that offer. Because those, you know, self-employed and rental properties, there may be a lot more documentation to gather. It may not be a 20-something, 30-day close. It may be more of a 40 or 45. It just really depends. Just much more labor intensive than it used to be.
So what you're saying is we should all have way more grace for our lenders right now, because life seems a little stressful.
That was well put. I've been doing this for 19 years almost, and it is actually by far the most stressful I've ever seen it over these last few months, by far. And every colleague that I've talked to, I mean, we have processors and underwriters that are working many 12-hour days, many people that are closers that are, you know, there's one night that at 11 o'clock at night, they sent a closing package and, you know, someone, a processor hopped online and they sent a thank you. You know, thank you so much for doing that late at night. And they're like, oh no, I have 13 more that I still have to get out tonight. So, I mean, people are literally, they're working around the clock. They really are. And people are, at some point, they're going to get to burnout. We're starting to see some of that. But it has just been going so hard and so long and so on. So yeah, it is, that's really important to have some more grace for that, because we're in an anomaly right now. This is not normal at all, not even close. So, and it's just a matter of that, you know, as I mentioned earlier, there's only so many bodies, so many appraisers, so many title company reps, so many process. I mean, you can't just go out and we're hiring people, but you can't hire them fast enough and to get them trained up and so on. We just have to expect that there are going to be just a little longer term time. Sometimes we're trying to hit everything, but yeah, it's a little interesting to navigate through the whole industry.
Yeah, that's really good to know. That sounds like a lot.
Yeah, it's kind of like the hamster wheel just keeps going faster and faster every day. So.
Yeah.
All good. Hey, you know what? I'd much rather be on that end than on the other side that we're all twiddling our thumbs and have nothing to do. So.
Yeah, true. Guys, that is the extent of my questions for Matt right now. Do you have anything that you would like to ask him before we wrap up? Steph, take it away.
Matt, so VA question. I've heard that like some people say like, yeah, I'm definitely qualified for this VA loan. And then you get down to the nitty gritty and they're like, yeah, they're not even veteran, or they don't qualify for the tier of that. So would you recommend from a realtor standpoint saying like, okay, do you have all your paperwork in order before we even start this process, or what would work from the lending side?
Yeah, so something that we do on the very front end is there's a document you could have them go ahead and pull out. It's called their DD-214. So it's their time and service. And that's something that we're going to go ahead and use. So what we're always going to look for is we go ahead and we go into a system and we try to pull up to see if they are qualified for a VA loan. That's the first thing that we're going to do. Like on a pre-qualification or pre-approval, we do that. If that doesn't pull up in the system, we may need their DD-214 form. Has the rest of the information, we're going to send that up. But that'd be a really good item for them to say, let's make sure. Because there are some veterans that they think that they qualify for a VA loan and they didn't have the time and service and so on.
Cool.
So that should never come down to that shouldn't come down late in the process.
Okay.
We know
Matt,
before
is there like a threshold of like, you have to have this many years in service to qualify for it, or does it kind of vary depending on what they were doing?
Yeah, it depends on when and certain time frames of, it just varies.
Okay.
Completely.
Got it. That's helpful. Guys, any other things that you want to bug Matt with?
Another question is, so folks that are like shopping around, right, for lenders, what does that process look, especially now with COVID? You're like, I'm so busy, please do you not want them to do that? What does that conversation look like? If you're like, go ahead and shop around for mortgages, with COVID, is there like a tight turnaround with that, or should they expect a week, or do you run a hard credit check for that?
Yeah, so it's really one of those things that by the time you write an offer, that really needs to be nailed down. It really should be, because at that point, if they're getting under it, and especially if we're helping someone to get under contract, that's really setting it up correctly. And then for another lender to come in, it may not set it up correctly, it may kind of mess everything up, and plus the timing of it too. That's really kind of more in the early stages before they're writing an offer is if they want to check around. But it really is important though. As an agent, is that you'll find over time is that the lender can make or break the deal. I mean, it's very, very true. And so it's really important there's some agents that will say, hey, just go use whoever you want, just go shop around. And then, there's going to be times they pick a lender, from someone online or some place you never heard of. One, it may be really difficult to get under contract because that pre-approval letter, the list agent is going to shove it off to the side. I haven't heard of them. But two, may not know what they're doing, and you may get all the way down to the end and it all falls apart. And that's not fun for anybody. Now the clients lost their inspection money, appraisal money, realtors spent all their time and so on. It's just a bad situation. So it's something that I recommend, and I've seen this over the years, is for agents to find good lenders, someone that they trust, that they're going to communicate with them along the way, so that way you're also not working with 6 different lenders out there on all your transactions and trying to chase information down. But find people that you trust and have them get in front of them and, analyze it, and then hopefully strengthen that triangle together. Because it really is an important component. And I think that's something just maybe talk with, some of the agents that have been around the office, just what their opinions are. They're like Jess Martin and Rex Fisher, Mark, and so on. If that's helpful.
That's so good. Thanks, Matt. All right, y'all. Anything else? Okay. Matt, thank you so much. Your expertise is phenomenal. Thanks for sharing with us. We really appreciate it.
Yeah, thank you for having me. So if anyone has any questions later, always happy to help out. So.
Yeah, this was super helpful. Thanks, Matt.
Hey, you're welcome.
Guys, tomorrow, Michelle and I are doing a high-level overview of all the technology you need to know. So it's a really fun one and really helpful, hopefully. So hope you can join us. We'll see you then.
Can I join that one?
Sure.
I need help with technology. So,
Well,
thank you.
Matt.
Everyone. I appreciate it. Have a great day.
Bye.
Bye.